Good morning, everybody. This is Dennis Wilburn with the Active Trend Traders, and joining us today from Dallas, Texas is Mike Traeger. Good morning, Mike.
Good morning, although not quite morning here anymore.
Okay. And then I should probably say Michael. I should say good evening because it's evening time over there in Switzerland, right?
Yeah, it is 7 p.m. It's
And so,
dark.
if we hook up with somebody who's from like Hong Kong or Shanghai or something like that, we'll have, a lot of the time zones covered all around the world. And so maybe who knows? We'll see where this goes. Let's get going. We got a lot of stuff to cover today. One is all the materials that we are presenting today are for training purposes only, and traders should always paper trade any new method prior to the risk of their own personal capital. Um, Here is Michael's disclaimer that is required because Michael is an independent investment advisor for a Swiss wealth management company. And I'll leave this up for a couple of seconds. You can come back and review the everything that is discussed here when you review the video. We continue with the Active Trend Traders, we continue our training sessions on Wednesday evening. We will have a training session this coming Wednesday. We're going to take off the Wednesday before Thanksgiving, though. This week's topic is going to be basically getting ready for 2016 with long-term trades, and I'll be providing some back testing to show some of the things that Mike Traeger and I have been working on for developing the longer term portfolio type management proposition, and I'm really excited about what that's is turning out to be and what it's looking like. And so that's what goes on with the Active Trend Trading Premium membership for the training every Wednesday night. Let's get into the market this week. I want to highlight, before we go into this week, I want to highlight some of the comments that were made last week. One, ask the question, are we at have we reached a climax? Because we were basically showing that the markets and the tracking indices were at resistance. And watch the weekly chart for a potential reversal candle on the S&P. NASDAQ dropping the breakout. Compare the NASDAQ 100 to the NASDAQ comp, and it was basically the tail of two different charts. Russell was weakest in holding, and our outside influence was the Fed, global stimulus, earnings, Santa Claus rally. As we move into this week, my question for the week is, how deep the plunge? Have we done our regular, routine pullback, or is there more to this? So I asked the question regarding the S&P. Is it a reaction pullback, or does it look like it has the potential of being more than that? For the NASDAQ 100, what's the path of least resistance? Is it to continue surging upward, or has it topped out? And I hear a lot of opinions from talking heads out there about we're going to surge higher, we're going to go lower, and the only thing that we actually have to be able to develop some clues from is what the markets tell us, or what the charts tell us. And those of you who read either the Traders Report and/or the Art and Science of Active Trend Trading free newsletter this past weekend, there was a great article by Mike Traeger that talked about a little bit about the breath of the market stinking. So I go, outside influence, your breath stinks. And the statement that I'll make here is the Fed never disappoints. We're about 4 weeks away from the last Fed meeting of the year, and everybody has basically taken as a foregone conclusion that the Feds have grown a pair and they will raise rates prior to the end of the year. And so I'll just throw, Mike Traeger, I know you like to talk about how much you love the Fed, and also the internals that you're seeing in the market. But does this outside influence and earnings are almost over for the third quarter earnings, But do those two comments kind of sum up what you're thinking?
Well, yeah, pretty much, kind of, sort of, I guess. Anybody who's been paying attention, the media tends to always want to report, the good news, and so there's a focus and maybe an undue focus on, some of the big cap companies that have been driving the indexes the last few weeks have come out with their earnings, and I'm thinking, companies like Amazon and Google, who had pretty good earnings reports, and the price action or the price reaction to those reports in those stocks has been spectacular. But if you look at the market as a whole, it's been a pretty disappointing earnings season. A lot of companies are not doing very well, and even if their earnings are maybe a little bit positive, their revenues are down. And when you take it all into a bigger overall perspective, it's been a pretty weak earnings season. And I saw what you drew there about the handful of stocks that have been driving this rally in the indexes the past few weeks. That's very true. If you want me to, again, I can name those stocks according to those acronyms.
Did I get the acronyms right?
The acronyms are absolutely correct.
So I was paying attention last Wednesday night.
Yeah, for a change.
Okay. So these reflect 8 stocks that basically both the S&P and the NASDAQ rallies have been hinged on. And so just for a refresher and also just to let people know, what are these stocks, Mike?
Well, starting left to right, Facebook, Amazon, Netflix, Google, Nike, O'Reilly Automotive, Starbucks, and Home Depot. And the factoid that goes along with these two acronyms is, referring to the S&P 500, which was a few days ago mildly positive on the year. It probably is not so as of today. But whatever the S&P 500 has been doing in a positive way has been driven by these 8 stocks. Without these 8 stocks, the S&P 500 would be down even more than it is. And if it was marginally positive a few days ago without those 8 stocks, it would have been a little bit negative.
Yeah,
and that's what we're talking about with the breadth in the market. We know with these cap-weighted indexes that a relative handful of stocks can drive them, even when the overall market, as depicted by the non-cap-weighted indexes, like the NYSE Composite and the Russell 2000, which are more democratic indexes, those charts just do not look the same as the NASDAQ and the S&P, which are cap-weighted.
Yeah, exactly. So, Michael Bischoff, how does what we're seeing in the U.S. market impact the European market? What keeps you up at night when it comes to your concern about what's going on in the U.S. market?
Yeah, I'm lucky that the honest answer is nothing. I sleep most of the time like a baby. But no, as the influence on the U.S. markets on the European markets, I think it's huge. And I mean, in the U.S. there is kind of this negative or possibly negative surprise that is, I think, almost priced in. That's an interest rate hike. And in Europe, it's maybe just the other way around. I think starting or mid-December, that Draghi, the president, will announce further stimulus. And I think it will be kind of an overlapping. So I think very, very hard to predict what this means for the stock market, but they are definitely correlated, and Europe is closely watching US.
Yeah, what I find interesting is there's been a few times, and Mike Traeger can bear this out, there's been a few times this year where our markets here look like they were really, really ready to get in gear to do some major correction. And either stimulus news from either China or Europe came out that came in like, and it kind of underpinned our market and almost put in a at least a temporary floor, and that kept things from running more quickly to the downside. Mike, you noticed that a couple of times, right?
Oh yeah, and you're right. It was either China or Europe or both. And in Europe, it's mostly Mario Draghi, who doesn't feel that the stimulus that the European Central Bank has provided previously over the past few years, the trillions of dollars that have been printed and thrown into the European economy, hasn't been enough, and it's not having the effect that they want it to have. So his answer is to just keep doing more of the same.
Yeah.
But every time he says that, the markets, at least so far, have tended to rally on his say-so.
And the thing.
I think important to note is that there is a big difference between Europe and US, because the ECB has not the power of the Fed. There's in the background there are 24 national banks, and for instance the Germans have been on the times basically, and it's an important national bank. The France, quite the opposite, is the French National Bank. They want to speed up. So with every Draghi announcement is at the end a compromise.
Interesting. So let's move on into getting into the individual markets here. Here's a chart from last week, the stocks on the NYSE that are above the 20-day moving average. And as we can see, we had rallied up. And while, yes, many of the stocks moved above their 20-day moving average, in reality, if you go to barchart.com and look at a similar chart of the percentage of stocks in the NYSE that are above their 200-day moving average, it barely budged. There's over 60% of the stocks in the NYSE are below their 200-day moving average, which typically means that prices overall are in a downtrend. Let's see where we're at this week. Oh, my goodness gracious. We have fallen from the sky. Let me get my pen back out here. What we were looking at last week, and we even talked about this a little bit, we were seeing a classic move up, a move back down to a new low. Then this is the classic part on a failure. You rally back up, but you fail to get back up to the old highs. And it's interesting, this is an index, but believe it or not, not kind of like an index, but it's an indicator measuring the percentage of stocks above the 20-day. Lower high, and then we get a total failure this week, and we've actually gotten almost down into the lower reversal area. And part of this drop has primarily taken place over the last 2 or 3 days, where the two non-weighted indices have actually really kicked in a little bit more to the downside. What might we see from here? we know that when it gets down in this area here, the indices are primed for at least a little bit of a bounce. So if we drop back down below the 30 and we start bouncing around down here, we may be it may lead to some sort of a relief rally. But it's at, and so I won't speculate on what will happen from there. All we know is at those levels, this is what tends to happen. The most recent rally, we'll be looking at the individual indices here shortly. So we may be getting set up, if you're an early warning alert person, we may be getting set up for a potential, again, a potential, we don't have it yet, but a potential standby alert. Once Mike and I have to look at some of our other indicators to see whether or not we're getting those kind of things. And right now, Mike, I know you've double checked, and I'm not seeing some of the other indicators falling into line yet.
No, not yet. Not as oversold as we would like to see them be.
Right on. So, Michael Bischoff today is going to be talking to us about the mind correlation and welcome to the new reality. Some of the research that he's doing, he's seeing a huge shift in asset classes. And so, Michael, I'm going to turn this slide over to you for you to tell us what we're looking at.
Yeah, I mean, it's not my invention or not my analysis, but and sorry, that's in German, but I think most words you will understand, especially if I comment them.
I hope you'll translate.
And it's from Bernstein Advisors, so it must be English. But yeah, I think the study was shifted around and then translated or whatever. But I think the result of this study is really, really amazing. So if you take a look at the bar chart, you see in red the correlation between different assets class in 2002 to the S&P 500. And there you see that first, so the long-term government bonds, mid-term government bonds. So that's not big surprise that they were negatively related. And if you compare it to 212, and I think 215 everything is, as the trend is even more, has been confirmed so far. There is still a negative correlation, which is good as an investor who wants to get a balanced portfolio. But the bonds have very low interest rates. Interest can almost for sure only go up mid-term and not down. So it's not a really good asset class to compensate your risks you have in stocks. So then the other thing was there's always the saying that you should diversify into an international market, and Europe always had a quite strong correlation to the US markets, as other development markets have. Then, I mean, hedge funds is a very vague class. I mean, it totally depends who's the hedge fund manager and what these guys are doing. But you also see there that the hedge funds correlate more and more to the S&P, and there are no good, appropriate diversification vehicle. Then also surprising that emerging markets is not they correlate. Sometimes as they don't correlate that much as the European markets, but it's still a clear positive correlation. I think there was only 2008-9 where was a negative correlation. Then what's really astonishing is that that commodities, that's Rohstoffe, that commodities are no good way to, that they also have a clear positive correlation to stocks.
Yeah, now Rohstoffe is what kind of a commodity?
I think everything except metals.
Okay.
Or maybe everything altogether. They maybe looked as to an ETF like DBC. Then bonds, emerging markets. That's also, or there's a huge difference between 2000 and 2012. So emerging markets bonds correlate to S&P also a lot, and so do corporate bonds.
And that's what these two are?
No, the first one is emerging market bonds, and the second is corporate bonds.
Yeah, okay.
Then gold is also, not a lot. I mean, 0.5 is not a lot, but it's still correlated to the S&P. And real estate, that's also a huge difference to 2002. That you have a strong positive correlation and not a negative correlation at all. So, I mean,
oh, hang on, Michael.